Very good afternoon to you. Besides coronavirus, if I can even ask that question, what's moving the markets?
Yeah, look, Nzinga, it certainly has just been that coronavirus, but monetary policy has certainly been moving its levers as well by the looks of things, especially the big banks there, the ECB, the Bank of Japan, and even the Federal Reserve out in the United States, pledging, of course, to move things along and being ready to help whenever they need to. And of course, we even saw the Reserve Bank of Australia, they're deciding to cut interest rates to around 0.5% as well. Record lows for them as they try to perhaps stem the flow that has certainly been coming out of global markets. That picture has been quite negative for some time, but we've seen 2 days of rally. Even here locally, we're seeing some good movement in terms of trade. But whether that's sustainable, of course, yes, the money may get pumped back into the system, but the sustainability of it will be dependent, of course, on how long the coronavirus kind of sits out in the market and kind of does create that tepid fear of growth and demand around the world. Let's take a look at what it has done exactly to the numbers today, and we'll get into the details right after this. Well, the weakness in the currency seemingly coming through from that fourth quarter GDP number, of course, negative 1.4% growth for the fourth quarter. South Africa only grew 0.2% in the whole of 2019, following on from 0.8% in 2018. Ian Cruikshank certainly correct a little bit earlier on to really say that South Africa basically has not grown at all, particularly over the last 2 years per se. But let's check in on this market movement and chat about it a little bit more. Sean Morrison from IG South Africa joins me here at the Johannesburg Stock Exchange. Sean, thank you so much for the time. Appreciate it. It's been an absolutely weird sort of and crazy sort of, I think, 2 weeks or so at the very least, right? And today, seeing some gains, 2.3% for the all-share index, 4% higher for that resources. It's all just... they're pumping money back into the system by the seams of things, are these central banks around the world.
Yeah, we saw the Royal Bank of Australia, RBA, cutting lending rates this morning. Indication is that the US Fed will cut rates maybe aggressively later this month. ECB possibly as well. But the picture doesn't change. I think if we look at the underlying effects, global GDP will be and is being affected by the coronavirus outbreak. It is contained to a degree within China, so the rate of new cases is not is not growing as quickly as it was before. But it is the contagion effect now. In my mind, it is already a pandemic. We're starting to see a growing number of cases outside of China. Europe, I think Italy is now the third largest contagion. It's great to see some green on the screens, but I don't think we're out of the woods yet.
So this is really just, I suppose, in many ways, hot money really making its way into this market and getting some gains.
I think it's a bit of a relief rally, a rebound from severely oversold conditions. Not to be the negative guy, but I do think this is, I don't think the picture's better. We know that it's encouraging, but we don't have a solution. We're treading in the unknown. We don't know how long and, the actual prolonged effect of the coronavirus and its effect on Q1 GDP. China is expected to have grown maybe 1% in the first quarter of 2020, and that's an economy. It's one of the fastest growing economies in the world. Usually over 6%. It's been up over 10%. So to see maybe 1% or flat, and certainly, I don't want to be negative, but the reality is when you see broad-based sector gains on our local market, I'm just a little bit untrusting at the moment. What is also concerning me is when we look at this gold price. The gold price is ticking higher. Gold price is a safe haven asset. So there's a bit of a disconnect to what we're seeing on the equity markets today.
Yeah, I suppose the question becomes, though, as that gold price ticks higher, the sustainability of it all is exactly just all we're talking about. Because yes, they've now decided that the Federal Reserves can, continue to pump the money in, I suppose, in certain aspects, whether it be China, Japan, Australia, the US. But if the pandemic continues, how long will the money being pumped into the
I just want to say, so they're injecting, they're sort of providing liquidity to the market, and we've seen China doing it as well. Unfortunately, that doesn't stop the supply chain disruption that we are seeing in places like China. So at the moment, you have a growing number of cases where you have quarantined areas. And what happens there is you have, manufacturing halted, exports disrupted. It's, we've had reports from Microsoft and Apple already talking about how their business are going to be negatively affected from that. And those are trillion-dollar companies. We haven't felt the full effects. We haven't seen them in the results yet. And I think while we might see some short-term euphoria, when we start to see results and the impact of the first quarter of the coronavirus, I think we'll see how serious it really is. Liquidity injections are not fixing the supply chain disruption at the moment in the market.
All right, let's turn to some equity news, and particularly locally. I got to chat to Mike Brown, the CEO of Nedbank, not so long ago. A company really suffering, as the economy locally has certainly been suffering too. We saw South Africa enter a recession in the third and fourth quarter last year, and clearly that business being a complete replica of what happened in the economy.
Yeah, so banks, especially our four major banks are, bulk of earnings come from a domestic market, and they benchmark their earnings growth and that to GDP. And when you're sitting at GDP of 0.2%, it's not really much. I will say that unfortunately that Nedbank results do seem a bit of an underperformance because so that headline earnings contracted by about 7%. Testament to a weak economy is seeing that sort of rising. The impairments are starting to rise substantially, and I think that increase in impairments is another reflection on people not being able to pay their bills in South Africa. And it's not just personal; it's also corporate. Because it's the investment banking side as well.
How do you think banks are meant to sort of navigate a time of slow growth as opposed to a global economy? Is it expansionary? Is it looking at ways to just minimize, or perhaps you create the environment by perhaps lending out a little bit more?
Well, I think like Nedbank and that have recognized a slow growth and a constrained economy. Well, that is global, but in South Africa in particular, and you start to look to expand in other jurisdictions, and I think the footprint is generally expanding into growth areas in Africa. I know Nedbank's doing quite a lot in Mozambique at the moment and West Africa with the EcoBank partnerships. So I think you've got to look for territories where there are growth and start to slowly migrate towards that. And then obviously within your mature jurisdictions, just work on operational efficiencies to try tighten the belt a little bit.
Good luck to Mike Brown, really navigating what is really a tough one there. Another one, Wilson Bailey Homes, construction has certainly hit almost rock bottom really in South Africa. Their operations in Australia aren't necessarily doing too well either. So really, really difficult for them.
So I was quite surprised with their results. I thought they were quite good on a relative basis. Construction industry has been under a huge amount of pressure. We saw the GDP figures came out. We saw that fourth quarter construction, the sector contracted by another 5.9%. So I think where Wilson Bailey starts to see they've increased their exposure to other jurisdictions. Their UK operations, Australia is still a problem for them. And I think just talking a bit broader, when you look at construction, it is a major employer. And unfortunately, that industry contracting is not doing it's not helping our economy, and the high level of unemployment we have, which is still sitting at 29%, decade lows. But on a comparative basis, a good set of results, I think, from Wilson Bailey, and definitely looking like a pick of the sector.
Do you still see their survival, though, over the next, 5 years even?
I think yes. Wilson, they seem to be doing quite well in the Cape, in the Eastern Cape, Western Cape regions. Not so well in Gauteng anymore. Contraction there. Increasing the investments in the UK, and slowly starting to turn around the projects in Australia. So I think all in all, If I had to pick a share within the construction sector, which
Yeah.
is a very dangerous, picking bottoms is a very dangerous game.
Very dangerous.
I think it is the major player to consider.
All right. Well, sure. Appreciate the time. Thank you so much for that. Really, really appreciate it. 2.33% higher than for the JSE All Share this afternoon. That seems to be the gain in the picture for the market for now. Some weakness still, of course, for the local currency. That 1.4% drop off in South Africa's economy for the fourth quarter certainly hurting. I suppose expected in many ways, in the sense that we were going to see that decline. Not much different though when one considers the data that has been out for the first quarter of this year thus far. Things certainly do look like they may continue to be in the doldrums. It's the third recession for South Africa's economy since 1994. That brings an end to this broadcast, though, right here at the Johannesburg Stock Exchange. My colleague Nzinga Kunta joining you right after the short break. Do stay tuned. This is SABC News from me. That's where the buck stops.